Welcome to investingnews.com. We're speaking with Simon Wensley from Metro Mining. Welcome, Simon.
Hello, John. Yeah, thanks very much.
You're welcome. For investors new to the bauxite space, how does the mineral fit into the energy transition?
Well, bauxite is the ore used to make primary aluminium, and aluminium is the most leveraged metal to the energy transition out of all the other metals. So, for example, if you added up all of copper, lithium, cobalt, etc., they would still not uh, come to the same level of demand increase that's flowing through from the energy transition. And that's coming from areas like transportation, particularly lightweighting of transportation, and particularly in that electric vehicle space where it's being used in car bodies, in batteries, etc. From energy generation, so electricity generation, particularly in solar, wind, etc., and also from areas like grid manufacture and grid installation. So, little known fact is that aluminium is used more in an electric grid than copper. So, of course, copper is growing strongly and is part of that picture, but aluminium is even more leveraged than that. So it's strongly leveraged to that over and above all of its existing uses in things like construction, in food packaging, and so on. So it's an extremely important part of that energy transition process.
Well, touching on the increased demand then for bauxite, how is this impacting the price?
Look, we do have to talk a bit about industry structure before we do that. Look, let's just talk about that aluminium space. There's about 100 million tons of aluminium produced in the world today. So that means that about 200 million tons of alumina, which is the transition product to get into aluminium, and then that means that it's about 600 million tons of bauxite required to make that alumina into aluminium. So, but of course, not all of that is traded. There's a lot of integrated production and refineries sitting on top of bauxite resources. So let's focus a bit on Asia Pacific, which is our area. There's about 180 to 190 million tons of traded bauxite in the Asia Pacific, and a lot of that, about 160 million tons, we're talking about now 2024 numbers, went into China. Now, when it comes to trying to look out for price in a bulk commodity, what we tend to use is a cost curve. So that's all of the producing companies in bauxite sort of put on a cost by cost basis delivered into the marginal market, and that marginal market, as I said, is China. And so, as we've seen over the last few years, that bauxite demand has been growing. It's been growing about 8% per year in this sort of in the traded space in Asia Pacific, and that's one of the reasons why we've wanted to participate in that. As that's been growing, though, the marginal tons of bauxite have been coming in from West Africa, mainly from Guinea. And so, as that's happened, the top part, or the furthest right-hand fourth quartile of the cost curve, has gone up in cost. So the cash costs of delivery from West Africa to China have been going up. That's from freight, from production, from transshipping, from taxes, royalties, and just the increasing costs of labor and so on in even in West Africa. So those costs have flown through to price, and the marginal cost of supply into China now is sitting at around 60 to 70 US dollars per ton. And so that's the minimum level that one might expect going forward, at least over the next few years, that bauxite will price. And if you look back at history, that's probably about 20 or $30 higher than bauxite has traded in the Asia Pacific prior to that. So there's been a structural shift in pricing as that demand for bauxite has gone up, and then as the supply has come in. And where Australian suppliers sit, and Metro is a good example, is that we sit at the other end of that cost curve. We're sitting down at the bottom end of that cost curve. So as that cost curve starts to steepen, and those cash costs of delivery go up, then that's where the marginal price is set. And so over time, you would expect those that price of delivery, that price for bauxite, to be set in that $60 to $70 range. And now and again, when you get extreme supply and demand imbalances, that price could spike. And we saw an example of that at the end of last year, where the price spiked even as high as $130 for Guinea bauxite. So almost double that equilibrium price.
Well, moving to Metro's own production, how is scale driving margin growth?
Well, John, it's a really important part of what we're doing. Most bulk commodities have a high level of fixed costs, and I think bauxite is no different. And at Metro, in fact, we probably have a higher proportion of fixed costs in our business than most other bulk commodities, and that's driven mainly by our location. We are a remote site. We have a fairly traditional mining technology and mining method, but we also have a transshipping part of our process that has another level of fixed costs. So, we in order to be able to then drive margin, volume is the most important aspect of bringing those costs down. So over the last couple of years, we've taken, Metro was set up round about that 3, maybe 4 million tons per annum scale. We assessed that as there was a market for our product, and we could grow, and that we were able to maybe double production up to 7 to 8 million tons, and we'd be able to leverage the fixed variable cost aspects of that. So over the last couple of years, we've implemented that expansion, and we now expect that our costs are declining, and we've demonstrated that year on year over the last couple of years. And our target for next year, so this is the sort of effectively the full implementation and optimization of our expansion, should lead us to around about that $30 per ton equivalent delivered into the market. So that's on the same basis as the pricing that I talked about a bit earlier. So absolutely, economies of scale are probably the most important part, over and above normal productivity, technology, all of those other good things that help to bring costs down. But economies of scale is by far the most important lever that we're pulling to get down to that cost number. And if we can achieve that number, we will be the lowest cost producer into that marginal market of China.
Well, therefore, based on these financial metrics, who do you consider are your listed peers?
Well, look, quite honestly, we're the only bauxite producer listed on the ASX. There are a couple of other companies that are in development or exploration phase. So it's probably better to look outside what we're doing. I mean, some of the other bulk commodities that have benefited from strong growth, people like coal companies, iron ore companies. You can think about some of the smaller listed iron ore companies, or indeed, some of the coal companies that were benefiting from growth over that period. But even, I might say, there are single asset gold companies that have really benefited from growth over the last couple of years, but they haven't been able to get those same types of economies of scale that we've been getting. So it's a bit difficult to make direct comparisons. But I would say, if you look out there at companies that are growing in that sort of we've now got a market cap of over $400 million, anywhere between that 400, and we're targeting $800 to $1 billion market cap over the next, as justified by the NPV of our business. Anyone in that range would, in those these growth commodities would be a decent comparable peer, I think.
Well, finally, Simon, what are the key catalysts investors should be looking out for 2025?
Well, look, I think, the things that we can control, we are endeavouring to control. So we have a slow Q1. We're trying to eat a little bit more into the Q1 part of our cycle. It's when we have the wet season up in North Queensland, and we do shut down. We try and take as much advantage of that as we possibly can by, scheduling maintenance for that period. And certainly, next year's Q1, we're targeting to try and take that to a cash neutral position by shipping some more tons. And we've enabled that through the implementation of more robust equipment, more resilient processes in our flow sheet. But between now and then, second half of the year is absolutely our best time. That's when the ore dries out. That's where we get the best tidal opportunities, when the weather Cape York is generally the best, and so we're targeting this year between 6.5 and 7 million tons of production. We've already produced and sold over 2 million tons, so it's a very strong second half where we should be sort of doing between sort of 4.5 and 5 million tons of production and sales before we hit the end of the calendar year. So over the next months and the next quarter, we should see a real demonstration of that expanded capacity flowing through. The market, look, obviously a bit difficult to predict. We had, as I mentioned earlier, some price spikes at the end of last year and the beginning of this year into the market. We did benefit strongly from that in our second quarter results. We were able to sort of still leverage some of that price and saw margins of over $30 per Australian dollars per ton through that period. It won't be as strong moving forward in margins, but the volume growth should be offsetting some of those more normalized prices in the second half. So as that volume comes through, as I said earlier, the costs will be coming down. So a combination of volume, cost reduction, and the market is still relatively strong, even if you compare it to the last sort of 3 or 4 years. So we still should be seeing very strong margins, in that $20 to $30 range.
Thank you very much, Simon. Busy times again. So thank you for updating investors.
No, my pleasure.